Welcome back. You're watching Stock Watch with me, Nolutando Mtonti Mlambo. And joining me to take your stock-related questions tonight are Rowan Williams from Nitrogen Fund Managers and Grant Nader from Bugilla Global Fund Managers. Please share your questions via email at stockwatch@bdtv.co.za, via SMS to 41392 or on X using the hashtag StockWatch. Gentlemen, good evening. Thank you so much for your time today.
Good evening.
All right, guys, we've got quite a bit to get through today. Very interesting questions. I'm going to start the first one off on one that I thought was a little bit rogue, considering that Twitter is not listed anymore, or X. The company is called X. So the question is, Twitter X is not listed, but I recently read that the Twitter X deal is one of the worst deals over our generation. Can the panel please explain how Elon Musk's Twitter buyout is or was the worst deal for banks? Not sure which one of you would like to take that one. But I'm keen to get your thoughts. Actually, both of you. Grant, let's start with you. What are your thoughts on that one?
Well, I don't know specifically why for banks, but I do know that they paid around 44 billion, if I'm not mistaken. They bought it at a time when the software and non-profitable businesses were already expensive. So he certainly paid up to own it. And I don't think it's even profitable, or it's marginally profitable. So he certainly overpaid. And of course, he dragged a lot of the banks in with him because he's got such a lot of net worth. I think that everyone backed him as much as anything. And so they've been taken along for the ride, and they've had to backstop and fund a big chunk of this deal. So, and I'm sure Elon Musk was smart enough to ring fence it. He put in what he was required, and the rest, the banks are exposed to whether this company survives or not. It may not be the end of the story. He does have bigger plans. His plan was to build it out into a platform rather than just a messaging app. So you could do shopping and various other things on it, much like WeChat that Tencent owns. But I haven't seen any evidence of that playing out yet. So I think at this stage, it's been a bit of a bad deal. But I'll just lastly say that he did cut about 90% of the staff. So he cut costs dramatically, and yes, lost some advertisers along the way. But I think it's more profitable probably than it was when he bought it. But he clearly overpaid, in my opinion, yeah.
And Rowan, your thoughts here?
Yeah, I mean, he did manage to hook in the banks for a substantial portion, probably 2/3 of the financing, and there were some other co-investors. So, and X, like a typical software business, has the intrinsic value is just in the software and the code and the brand. It doesn't have any hard assets. So the banks were probably left with very little sort of security on their loans. So if things and valuation has already, it seems, diminished significantly. I think he cut costs, but he also alienated advertisers. And so I think the revenue prospects are much lower. If you've read Elon Musk's biography, you might get an idea there was an emotional aspect. He wanted PayPal to be known as X when they launched it. It didn't work out that way. It seemed to be a second act for him. So I think there was a lot of emotion behind the transaction as well, which is never a good thing. So I think it's just a question of how much money are they going to lose. So that will remain to be seen over time, but certainly substantial haircuts on their original debt and investments that have been made by all investors, all financiers concerned.
Well, certainly a very different app since he acquired it there. I'm keen to move on to our next question now. It's around growth versus value stocks. It says, is this time for growth stocks or value stocks? What are some of the panel's favorite growth and value stocks, especially as interest rates are set to be cut? Okay, Rowan, I see you nodding, so I'm going to go with you here.
Yeah.
Yeah.
Yeah, so I think the sort of distinguishment between growth and value, it's sort of a kind of a label that doesn't want to go away. So, I mean, the growth stocks are those high PE stocks with very high multiples and high growth rates, and the value stocks tend to be less interesting, sort of more a discount to intrinsic value. So there can be a season. I think we're certainly into a rotation period now as we see rates come down. And I think there is the opportunity to, you've done very well in the growth stocks, particularly those Magnificent Seven. There's a lot baked in, and I think as rates come down, investors are going to be looking for more broader value that the market will generate, and the breadth of stock appreciation should be much better than it has been. So if you haven't rotated out of some of your growth stocks, it is opportune to do that and look for more stocks that may be more broad-based, not as sexy parts of the economy, utilities, more basic industrials that are growing at a reasonable rate, and a lower rate environment would be more conducive for their operating environment. And I think you can do quite well if you rebalance your portfolio at this point in the cycle.
Great. Grant, would you like to add to that?
No, I think I just wanted, perhaps I'll add that you don't need to categorize growth or value, just understand what are you paying for what you're getting. If the stock has growth, what are you paying for that growth? If the stock looks like it has value, what are you getting for the value? Sometimes, don't be sure not to blur the lines between the value traps and the growth. There's also growth traps where you overpay and you never earn your way back into that multiple you're paying. So, just I wouldn't categorize either or. I'd just look at, are you paying the right price for what you're getting, and then be comfortable with that. And certainly, I think as we move into a rate cutting cycle, as Rowan mentioned, you're going to see opportunities in some of the industrial type of places, maybe some more consumer staples, or something that's more touching into the less exciting parts of industry that are trading a bit cheaper. But as long as other companies are still growing and driving their earnings, they should also continue to perform well. So don't make sort of wholesale changes, just incrementally look for new opportunities without saying, okay, I'm cutting all my growth and I'm buying all this low growth because it's going to do better. Just, make those incremental changes as you see opportunities is probably a good way to go about it.
So that's solid advice indeed. I want to move on to another question, I think very similar to this question, except now we are looking 5 years ahead. It says, itching to invest in a stock that will see great gains in 5 years' time. What stocks would the panel suggest as a valuable buy that isn't seen as a great investment right now? It's a bit of a quick, confusing question, actually, if I think about it. Rowan, I'll let you take. I don't know if that face you put is because you're as confused as I am, but please go ahead.
So I guess, what the viewer is saying is something contrarian. I think that people sort of are ignoring, and essentially the prospects for the next 5 years aren't already baked into the share price. So if they are, you should get a market-based return. And I think a lot of those sort of brand name stocks, call them that, obviously are very popular, so their prices are very full, expectations are very keen. So if, say, NVIDIA, as an example, just achieves its 5-year earnings forecast or growth forecast, it'll probably just justify the price today. So you're not going to get really market-beating returns. So it has to be something sort of rough diamond, undiscovered, maybe a bashed-up balance sheet that's going to get fixed, and management are doing the right thing. So if you want an idea of a stock, you can go with something that's safe, something like, I think, Naspers, just because of how they have a very strong focus on value realization, and it is in a 5-year time horizon. So notwithstanding, it's not sort of ignored, but the discount is still very evident. 40% plus to NAV. The new management team are heavily incentivized to narrow or eliminate that discount. So they've got real money, like $100 million of incentive to do something material. So, and you've got the underlying assets, which you understand. So it's not like a rocket science thing. They just need to execute. And it looks like 5 years is a reasonable time frame. So that would probably be my sort of safe pick in that space.
Grant, and your pick for this one?
So I think Rowan's right. You have to be looking somewhere no one else wants to be buying, and where you're going to find the value. And you know what? China is one of those regions right now. So that's a massive economy. It's growing at 4.5% a year. No one wants to touch the stocks. The stocks are cheap, and they remain cheap. So yes, you're contrary to what's being expected, but there's definitely value there. There's still some risk, but I think the underpin of value sort of, pays you for that risk. And so you could look at the likes of an Alibaba or some of these other Chinese stocks that are actually really good businesses, just very beaten down. And, Tencent would be an example. It's not as beaten down, but it's a very good business, tainted by the Chinese brush. And I think you could do well there over the next 5 years.
Actually, before we go to the ad break, then I'd like to take this next question about Naspers process, because you've mentioned Naspers, Rowan, and you've mentioned China here. But we have a question here, Grant, that says, at some point, and this couldn't stop speaking about Naspers and process, now not so much. What happened? I'm wondering if it is that Chinese brush that we're speaking about here, Grant. What happened here, or is it just, people are still speaking about Naspers and process, you're just maybe not listening to those conversations?
I certainly don't think anything's wrong with Naspers and Process. I think they're still very good investments. I think what's happened is there's a lot more other opportunities happening in South Africa that we haven't seen in a long, long time. There's a lot of things to get excited about. There's been some great performances from a bunch of our equities. The stock market's at all-time highs, and normally that would only happen when Naspers and Process was roaring back in the day. So I think there's so many other exciting things on the go, many other good opportunities. So that's just taken a bit of a back step. But I certainly don't think it's gone away as a good opportunity. And you must always remember what it brings to an SA portfolio. It brings global growth exposure and technology exposure that you don't get easily in South Africa anywhere else. So don't ignore it.
Yeah. Rowan, you share those sentiments?
Yes, I think Grant's absolutely right. The narrative has changed around, investing in South African equities to the domestic investment opportunity, which is fantastic. I think for a very long time, it wasn't considered a great investment opportunity, and now it is. So you could say, also speaking to the viewers' question, the prior question, the next 5 years for South African equities, I think, are looking very promising. Partly because they've been ignored for so long, they've lagged, and they really should catch up. Valuations are still very reasonable. So it's right, I think, that is the sort of the investment case or the investment story that's at the forefront of investors' minds. The Rand, has strengthened quite a bit. It sort of takes the shine off Rand hedges as well. So just some reasons, that where the narrative is at the moment.
Gentlemen, our next few stocks, or questions rather, are around AI. My question actually for this week is around NVIDIA. Expectations for it. We know that this has been one of the most widely spoken about counters this year. Very impressive. Can we expect that trajectory to continue? Rowan, what's your thoughts on that one?
Yeah, so it has been an amazing investment story, and the sort of multiples that investors have made over the years have been fantastic. I think a very dynamic business, very well managed, very exciting space, and really clearly the market leader there. So what's interesting to see is the amount of investment, CapEx, that a lot of other software companies are budgeting for and indicating on their future plans. Obviously, that goes and that benefits NVIDIA, because they're the main beneficiary of all this AI spend that's going on. So expectations extremely high, but I think just given the hype and the mania at this point in time, I think they're likely to deliver. I think what is the bigger concern is more the forward projections over the next sort of 3 years. Clearly, there'll be new competitors, there'll be better chips, better technology, and I think maybe super profits at the margins that they're making at the moment, which aren't necessarily sustainable. So they'll probably deliver on expectations in the near term, that's my feeling, but I think they may disappoint a little bit further out in the sort of forecast time horizon.
Grant, I'll let you take the other AI question here. I bought stocks in Intel as an alternative AI play, but that stock has been a little bit disappointing to date. Should I jump ship?
Oh, it's almost like the bomb's already gone off with Intel, unfortunately. Yeah, I think you've taken so much pain. If you've invested in Intel more than a month ago, it probably makes sense to hold on for something of a recovery. They have got their new cutting-edge chips coming online next year, which may bring them into the game. They've got the latest technology, the latest machinery from ASML, etc., and that's going to be competing with TSMC and Samsung at I think it's the Node 2 or whatever it is, the cutting edge. So if they can get that right, there might be a change in sentiment and an uplift. Fundamentally, though, this company's made one bad capital allocation decision after the next. they're also competing with chip designers. They're competing with the fabs. So most of the companies are specialist fabricators or designers or packagers. Intel's doing it all. So they're an integrated chip manufacturer. And I don't think they're doing any of it really well. So I don't love it. I wouldn't buy it here even personally, but I think if you already hold it, you just hold on to it and look for a better chance to maybe exit. Unless they start changing something fundamentally in the company and the way they operate, I don't see a fantastic outlook.
Guys, before we move away from chips, I also want to just find out about your thoughts around the geopolitics around them. We have this American election coming up. It's one that is very interesting to watch from here. But the chips and the chip stocks, they really are the ones that stand to be some of the biggest losers or gainers from whatever emerges there. Is there still a point with watching something that if you're invested in, whether it's NVIDIA or Intel or any other of these chip makers, just be watching very carefully the conversation around what could emerge there, Rowan?
Yeah, so certainly I think you've got under a Republican presidency probably increase in protectionism and probably anti-China policies. So I think that's the direction that you're going to go in. Obviously, the Democrats less so. They have been somewhat hostile already. I think that's also to sort of garner votes. But what's been interesting to see, so I think a fair amount of sort of the restrictions are already in the prices and the expectations. And the likes of Huawei have actually seemed to get around a lot of the restrictions. They've still got very advanced AI chips that they're developing and selling. So I don't think it's as material. It may be an impact on sentiment, because it's that's the sort of prevailing view is that Republican presidency is negative. But I don't think it's going to have that much impact on the ground. I mean, they may ratchet up sort of restrictions and protectionism significantly. In that case, it is bad. But I don't think that's great for America and sort of advancement of American technology. So I think it'll be more noise than sort of actual impact.
Staying with American tech stocks here, we have a question. Should I continue to hold my Apple stocks? That's the whole question. So, Grant, would you keep holding your Apple stocks?
I think firstly, you define your timeline. If you're talking about 3, 4, 5 years, I think absolutely. If you're talking about 3 to 6 months or sort of shorter term, it's done well. It's on the very much the upper end of its valuation multiples. You could probably find cheaper value. You could probably find good stocks for better prices. But if you're thinking longer term, this is a great business. I don't think it loses relevance. I think they've got the upgrade cycle, of the on-device AI that's coming. So the iPhone upgrade cycle is going to come with that, and that should see renewed growth. So I think it's still a great business. Is it cheap? No, it's not. But if you sell it here, will you buy it back if it has a small pullback, or will you watch it go on without you over the next 3, 4, 5 years? So define your timeline and decide that way. That's my view.
Got you. I want to move on now to some very interesting questions around emerging markets. We'll start off with India. A question here. With India being the fastest growing economy in the world right now, what can the panelists tell us about the stock market there? Is there money to be made? And I'm wondering, we don't actually hear much about India's stock market. Rowan, do you have any thoughts on that one?
Yeah, so that's and it goes back to our discussion around sort of growth stocks as well. So often what you see is investing in high growth economies and industries aren't necessarily great investments because more than enough is baked into the price. So the Indian stock market has done incredibly well. The whole growth story there has been phenomenal, certainly taking over the lead from China, which I guess from an EM perspective is a little bit ex-growth or starting to go ex-growth, notwithstanding the 4% growth rate. So I think it's worth looking at. The Indian market is quite complicated. It's complicated for foreigners to invest as well. They've got quite a lot of restrictions around foreign ownership. So that's complex, which you'd have to sort of navigate. But maybe an ETF. Certainly, I think the economy is going to continue to grow at 7-8%. You're going to have to look at the valuations and see if they have baked everything in or too full or not. So that requires a little bit more discernment because certainly not a new story. But I think I think there's probably potential for growth. You can look at some South African companies, one or two have a bit of India in their portfolio, which look quite interesting. Momentum, for example, has an operation in there that looks like it can continue to grow. So you could pick up exposure in different ways as well.
Grant, your thoughts on India?
Yeah, I think it's a great story. If you look at the GDP per capita comparison, it's roughly, I think, where China was about 20 years ago, let's say. And if you look at that opportunity set, so there's still a long runway for growth. It's not the same story as China in the type of economy it is, but they've got a massive urbanizing population, huge demographic tailwind that China had 20, 30, 40 years ago. They don't have it anymore. And I think you'll also find they are well positioned. The West wants them to succeed because they need some counterbalance to China. So there's a lot of foreign investment going on there. Growing 6.5% to 7% a year for the next 10 years is what's forecast. Now you can imagine a company like Shoprite growing in an economy where the GDP is 6 or 7% relative to the 1% here. So the staples businesses, the really basic industry in India are doing tremendously well, and I think they'll continue to do well. Yes, they are perhaps slightly expensive. It's very difficult to invest directly there. Maybe invest in a basket of securities is the safer way to play it. But I think, again, 5, 6, 7 year view, I think you'll do very well there. In the short term, it's not cheap. The stock market's certainly pricing in a lot of that growth.
Got you. Another one here on Japan. Can the panelists give us a Japanese yen for dummies crash course? I chuckled at this one, but I mean, really, guys, can you give us a Japanese yen for dummies crash course? Rowan, what is happening with the Japanese yen?
So yeah, the yen has been a very favorite carry trade currency, which means for decades, the deposits in yen didn't attract any interest. If anything, it was negative interest. So a lot of what they term Japanese housewives would take their bank deposits and buy a high-yielding currency. So swap a yen deposit for, say, a South African rand deposit. Obviously, pick up the significant interest income, 9%, say, on a deposit. As long as the rand yen doesn't depreciate by more than 9%, they're getting a pickup on that trade. And there could be the potential for rand appreciation, which there has been recently. So that is what drives the yen to some extent. And when they raised rates recently, obviously that makes these carry trades less attractive, and people sort of panicked and decided to liquidate those carry trades. And that obviously reversed the valuation, and the yen appreciated. So it created a lot of sort of confusion and losses, I guess, in the carry trade. So that what was creating the volatility. There's a potential for another rate hike. So it does create complexity around that. So more volatile than it should be, I guess, the Japanese yen.
Grant, anything you'd like to add here to our Japanese yen for dummies crash course?
No, I think Rowan summed it up beautifully. Maybe I'll just add that a lot of these, rather than just looking for yield, a lot of the hedge funds and the like were actually borrowing in yen and buying tech stocks and the likes, so really speculating with it rather than just looking for a little yield pickup. And that obviously, that was a bit more volatile in the unwind, because those things have margin attached to them as well. A lot of them are buying on margin. And so there's this sort of reinforcing as the stocks fall, so they have to sell more to fund the margin. Anyway, so it was a lot of noise, and I think it's that kind of volatility is really should be seen as an opportunity and not something to be afraid of.
Well, we are unfortunately out of time. I'd like us to go into our stock pick segment. We don't have much time. Robin, which counter are you loving this Monday evening?
So we're going with Santam. It's really a geared investment trust, largest insurance, short-term insurance group with a very large investment in bonds and cash and equities through their free float. So the underwriting cycle looks like it's turned. A very good trading update. The share has appreciated, but you're getting sort of a geared investment in the domestic equity market. So it looks very attractive, particularly if we expect equities to continue to run in South Africa as we do.
And Grant, from your side, which counter are you loving?
So I'm going for Growthpoint. It's been unloved for quite a while, and that's because it has about 50% of its portfolio exposed to the office space, and we know office has been almost hasn't recovered from COVID. But I think as we move into this rate cutting cycle, you're going to see their strong retail portfolio like the V&A Waterfront, which they have, being complemented by a recovery in offices as the SA economy surprises to the upside, which we think it will. And so you'll see a re-rating and in Growthpoint. And in the meantime, you're getting paid a dividend yield over 9%, still got a very strong balance sheet, high quality business. So that's what I think is the opportunity of the day.
Well, gentlemen, always a pleasure having you on Stockwatch. Thank you for your time this evening. That's all for tonight's Stockwatch. Thanks to our guests, Rowan Williams from Nitrogen Fund Managers and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay tuned.